You pulled $10,000 out of your 401k because life just punched you in the face. Months later, the IRS sends you a bill for $3,400 of that money back. Over a third of it gone, not a typo. Most people have no idea how 401k withdrawal rules actually work. They think it's their money, they can take it whenever. And that one assumption costs them thousands every single year. My name's Tony Hong, I'm a licensed CPA and have helped thousands of clients save millions in taxes from the IRS. But let's break down exactly how this penalty hits, and more importantly, the legal escape hatches the IRS built in that nobody tells you about. So how does $10,000 turn into a $3,400 bill? It's not one penalty, it's a 1-2 punch. Punch 1, regular income tax. When you put money into a traditional 401k or IRA, you got a tax break. The catch, the IRS collects when you take it out. So that $10,000, they see it as $10,000 of fresh income. You're in the 24% bracket, that's $2,400 gone before your state even asks for their cut. Punch 2, the 10% early withdrawal penalty. You touch that money before age 59 and a half, the IRS adds another 10% on top. That's another $1,000. So let's do the math. $2,400 in federal tax plus a $1,000 penalty, that's $3,400. Your $10,000 just became $6,600. You lost 30% of your own money because you needed it before a date the government picked. Now here's where it gets crazy. Most people stop reading after 10% penalty and assume that's it. But there are actually different penalties depending on which direction you're going. Pulling money out too early or not pulling it out soon enough. It's easy to just get mad at the IRS, but there's a logic here. The government gives you a massive tax break on these accounts because they desperately want you saving for retirement. Your money grows tax deferred. No taxes on contributions, no taxes on investment gains each year. Your wealth compounds way faster than a normal account. That 10% penalty and the 59.5 rule, that's the government enforcing the deal. They're saying, we give you this superpower, you use it for retirement or you pay. Quick side note, if you're watching this thinking, I need tax help, that's what we do all day. I run the CPA Dude. We build custom tax savings blueprints where we go through your last 3 years of tax returns and your current year income, find at least $3,000 in legal tax savings, or we refund the fees. There's a link below this video, click it now, answer a few quick questions, and grab a time this week. My team will show you what you're leaving on the table. All right, back to the breakdown. The second you hit 59.5, the 10% penalty disappears, gone forever. You still pay income tax on the traditional account withdrawals, but that extra gut punch is off the table. The IRS knows life throws curveballs, so they built in specific exceptions, legal escape hatches, to get your money early without paying that 10% penalty. Now listen, you still owe regular income tax on that traditional account withdrawal, but dodging that 10%, that's a massive win. Here are the escape hatches for IRAs. First time home purchase, up to $10,000, it's a lifetime limit, yet it's penalty free to buy your first home. Money has to be used within 120 days. Higher education cost, penalty free withdrawal for qualified college expenses. Think about tuition, books, and they have to be for yourself, your spouse, your kids, or even your grandkids. Major medical bills, health insurance while unemployed. Lose your job and receive unemployment for 12 consecutive weeks? You can use IRA funds penalty-free for health insurance premiums. Total and permanent disability. The 10% penalty is completely waived. Birth or adoption. Thanks to the Secure Act, up to $5,000 penalty-free within 1 year of a child's birth or adoption. SEP, substantially equal periodic payments, also called 72T. This is the expert level move. You agree to take fixed payments over several years. The rules are incredibly strict. One mistake and the penalty comes roaring back retroactively. Do not attempt this without talking to a financial professional. But here's what people miss. These exceptions are for IRAs. 401k rules can be different and often more restrictive. Some exceptions, like the age 55 rule, only applies to 401ks. And none of these happen automatically. You have to file IRS Form 5329 with your tax return to claim the exception. Skip that form, pay the penalty. You think you're safe once you pass 59.5? Think again. There's another penalty on the opposite side for not taking your money out. It's called the Required Minimum Distribution, or RMD. The IRS lets your money grow tax-free for decades. Now they want their cut. Starting at age 73, you're required to withdraw a minimum amount from your tax-deferred accounts every year. First RMD is due April 1st of the year after you turn 73. After that, December 31st every year. And the penalty for forgetting, 25% of the amount you should have withdrawn. Let's say your RMD was $40,000 and you forgot, that's a $10,000 penalty. The IRS might reduce it to 10% if you fix it quickly, but you have to ask for forgiveness. The one account with a get out of jail free card, the Roth IRA. You're never required to take RMDs from your own Roth IRA, ever. When you retire, that system's gone. Your income is now a mix of Social Security, maybe a pension, and your own withdrawals, and nobody's withholding the right amount for you. The US runs on a pay-as-you-go tax system. So the IRS expects their money throughout the year, not all at once on tax day. So if you take a big IRA withdrawal in January and wait until April to pay the tax, you can get hit with an underpayment penalty. To dodge this, you can use safe harbor rules. You generally avoid the penalty if you do one of two things. One, pay at least 90% of the tax you owe for the current year through quarterly estimated payments or withholding from your retirement distributions. Two, pay at least 100% of the tax you owed last year, 110% if your adjusted gross income's over 150 grand. The simplest move, when you take a retirement withdrawal, you can elect to have a custodian withhold a percentage for taxes right then and there. Problem solved. So let's recap. Pull money out too early, 10% penalty plus income tax. Pull it out too late, 25% RMD penalty. Don't pay tax throughout the year, underpayment penalty. The IRS has traps on both sides of retirement, but now you know where they are and how to walk right past them. And if you're still watching, you're probably exactly who we help. If you're a business owner, real estate investor, or high earning W-2, and you got that feeling you're overpaying the IRS, here's your next step. Click the link in the description that says Tax Discovery Call. It takes about 2 minutes to answer a few questions and grab a time on our calendar this week. On that call, my team will walk you through your tax situation to see if our tax savings blueprint can save you from overpaying taxes and keep you protected from audits before next tax season hits. If we can't find at least $3,000 in legal tax savings, we refund the entire blueprint fee. And if you decide to have us implement the plan, we credit that fee towards your membership. So the blueprint and strategy is effectively free. We cap these blueprint spots around 10 per week so we can actually do the work properly. If you're seeing this and there's still availability, click the link now and lock in your spot.